Hey everyone, I'm Jeremy Szafron. You're watching Kitco News. Don't forget to hit the subscribe button for the latest. Well, consumer sentiment in the U.S. has just reached a 4-month high, according to the University of Michigan's preliminary report. Short-term inflation expectations have dipped to their lowest level since late 2020, with consumers expecting prices to rise at an annual rate of about 2.7% over the next year. Now, that's a positive sign, suggesting people are feeling more optimistic about the economy. But it's not all smooth sailing. Despite the uptick in confidence, the U.S. housing market just had its worst spring selling season in over a decade. Home sales during this crucial period dropped to levels we haven't seen since 2012. Mortgage rates, of course, have climbed above that 6% mark, more than doubling from historic lows just a few years ago. This has many potential buyers sitting on the sidelines, of course, waiting for those rates to come down. Meanwhile, all eyes are on the Federal Reserve's upcoming meeting. Markets are fluctuating between expectations of a 25 or even a 50 basis point rate cut, moves that could send ripples through bonds, stocks, and commodities. Now, the 10-year Treasury yield has dipped below that 3.65% mark, reflecting the market's anticipation and uncertainty over the Fed's decision. Now, with consumer optimism rising, but significant economic challenges ahead, how should investors position themselves? Is it time to seize new opportunities, or should caution be the guiding principle? Well, to help us make sense of all of this, let's welcome Meb Faber to the show. Meb is a co-founder and chief investment officer at Cambria Investment Management. He's an expert in global asset allocation and quantitative investing, and he's been author of several influential books on investment strategies. Meb, thanks for joining us. Welcome to Kitco.
Great to be here.
Okay, we got lots to get into. As we just discussed, the U.S. Housing market has experienced its weakest spring selling in over a decade. I guess home sales are down to those 2012 levels. Of course, we're seeing, mortgages at about 6.25%, more than double from those lows that we saw prior to COVID. How do you think that this is going to affect the real estate sector moving forward? Give me your outlook here. What's the story?
The real estate sector is pretty varied. We manage a global real estate REIT fund. And on average, if you look at the income across the board, the valuations for the REITs in general are not that cheap. That having been said, again, saying REIT is like saying the average dog, right? You got a Dachshund, you got a Beagle, you got a Great Dane. They look nothing like each other. So you got data centers, you got single family housing, you got commercial, and they all kind of zig and zag. But
you're right.
I always laugh anytime, particularly when we're talking about housing, especially here in the US, you talk to our parents' generation, or you talk to people about inflation, and they say, what are you guys complaining about? In the 1970s, 1980s, my mortgage was double digits and we still got by. So, I think it's a challenge. I think there's better investing opportunities out there if you're looking to put money to work than REITs, which is a strange comment from a REIT manager. But global REITs to me look a little more interesting than American ones do.
Yeah, it's interesting. I mean, we keep seeing these headlines about the commercial real estate problem in the U.S. Obviously, there's not a lot of people buying homes right now. But, I mean, analysts argue that if the Fed cuts interest rates soon, maybe this housing market will come back. But it seems like there's a lot of people just kind of taking advantage of this locked-in effect. Where are we? I anticipate this to be a sluggish move for the next couple of quarters.
My favorite way to think about the Fed, everyone gets hot and bothered. What are they going to do? Are they going to raise lower rates, 25 bips, 75 bips? And if you look at a long-term history of the Federal Reserve, you can compare the Fed funds rate to the 2-year bond yield. And over time, they are neck and neck. They may zig and zag a little bit, but eventually they catch up with each other. There's periods where the Fed funds will go an extended period below or above. So the long period of getting pegged at 0% was one of those periods. But if you look at the 2-year right now, it's substantially lower than the Fed funds rate. And so my conspiracy theory is that the Fed actually just goes into their meetings. They have a few beers, maybe some wine, watch Seinfeld reruns, and then they just kind of peg it to the 2-year eventually, right? And so if you look at the 2-year today, it's substantially lower. So at some point, at least the market is saying that those rates need to come down.
Yeah, the market's saying it, but I mean, I started this year reporting on 6, 7 rate cuts by the end of the year. Here we are looking at 1, potentially 2. I mean, what the heck is going on? Have we just outrun it?
Forecasting bond yields is probably one of the most challenging. Future bond yields is one of the most challenging things in all of macro. You can see that a lot of the Fed prognostications, as well as the gurus. You look at the kind of yearly Barron's or other reports, and everyone almost always gets it wrong. And so the job of an investor is to say, hey, what does everyone expect? And then, of course, how is my view potentially different, or how can the world play out in a different way? Am I prepared for interest rates to be 10% or zero? A lot of people, negative interest rates weren't in the textbooks when I grew up. I don't know about you, but we went through a period where there was negative rates around the world, many places. Like, that was a weird time. So you got to prepare for these sort of outlier events. If we know anything about markets, it's about the most interesting things happen in the tails, right? In both the bad sense and in the good sense as well. I mean, if you look at US stocks, since 2009, they've done 15% a year. That's only happened 4 times in history, right? So you got to be prepared for the outliers on the downside, but the good ones too.
Yeah, I mean, okay, so to your point, I mean, we talked to the parents, and obviously inflation was a huge issue. Their mortgage rates were way more than us growing up. So did we just get used to cheap money here? I mean, we had a lot of stimulus coming in. What's the bigger problem?
The thing about inflation is everyone thinks in nominal terms. And so, investors as well as consumers, even if you have high inflation and it comes down, it's still at a plateau, right? No one really reduces prices a bunch afterwards. They get sticky. And that's the challenge, I think, for people. But inflation is the investor's worst enemy. And if you look at returns for the past 120 plus years, one of the best scenarios to be in is high inflationary markets. And then when the inflation comes down, and I'm talking about, much higher inflation than kind of where we are in the US today, something like in Argentina, where it's very high and comes down. Historically, that's a great time to be invested in traditional financial assets. The opposite is one of the worst times, right? But after inflation nets out is really all that matters. We call it returns you can eat, right? Because a 10% return with 10% inflation is not the same thing as a 10% return with 2% inflation. So everyone tracks the nominal value. But right now, particularly in the US, even with this inflation and interest rates, we think stocks are pretty expensive, better opportunities elsewhere outside the traditional market cap weight.
Interesting. Okay, well, we need to get into that. But before I do, it sounds like you're not really watching Powell's next moves, Meb, but are we going to see a small 0.25% come off next week? Is that kind of your outlook here?
I remember back to the time of Alan Greenspan and, trying to decode what he was saying. He had a joke where he was basically like, if you could understand what I'm saying, you must have misinterpreted me. This generation of Fed tends to communicate quite a bit more. They telegraph quite a bit more what they're doing. I think so the expectations get baked in a bit more. For me, it's more thinking about what's this going to look like in 6, 12 months, what is the general path? And the general path is moving from an environment of interest rates coming out to interest rates coming down. And that's a much different environment for markets in general. And then we've had this weird environment where we've had this negative inverted yield curve for a long time. And historically, negative yield curve is an environment where all sorts of different investments do better than in a traditional yield curve environment. So you're seeing gold at all-time highs. You're seeing T-bills, T-bills and chill, I think was the phrase the last couple of years, where inverted yield curve, that's the best investments, which if it normalizes, transitions to a different set of investments that do well.
Yeah, interesting. Okay, well, I definitely want to get your outlook on gold at some point. But before we do that, we didn't touch on this earlier. Obviously, this year's kind of been a little bit of an AI boom. I mean, it's been one of the biggest stories in the market. Tech companies involved in that whole area have seen their prices, their stock prices soar, contributing to pretty big gains on the S&P too. We know outside of the Mag 7, even during last week's sell-off, we saw people come and buy the dip. From your perspective, is this surge in AI stocks sustainable over these evaluations in the long term here?
If you look at the long history of stock returns, and I'm talking about not the last week, month, quarter, but really the last century, Technology has always been a constant. Now, what people called technology for different eras has been, different. So you had microprocessor and the internet. That was my favorite bubble. But you also had, plastics, railroads, TV, telecommunications, everything, right? And you go through different periods where everyone gets excited about anything. If you actually look at the best performing stock of the last 100 years, it wouldn't surprise people, but you put $1,000 in this stock that's worth 2 billion plus today. It's a tobacco company. So you don't necessarily have to be in the hot names. Now, if you own the market, you're guaranteed to own them. So that's one way to do it. Be a good old index investor. The problem, the Achilles heel of index investing, if you're a market cap weighted investor, is it has no tether to fundamentals. And so most of the time, that's okay. But when things go totally nutty to the upside, you kind of detach from reality. So there's no tether to earnings, revenues, sales, anything. It's just the price of the stock and the shares outstanding. And so when you get these periods where the whole market, particularly the concentrated big stuff, goes up a ton, so think late 90s, think back to 2022. Sorry, the years are peeling off. The market is expensive. There's no question these names are expensive. The reality is, will the earnings be able to sustain and meet those expectations? That's a very high bar, right? So the good news is it's not just a stock market of 7 stocks. There's thousands of stocks, and most of the stocks out there, particularly in the mid cap, the small cap, the value, the high quality names, look wonderful. But the challenge is you need to move away from the traditional market cap index. Otherwise, you have a very concentrated, very expensive portfolio.
Yeah, absolutely. So just too much exposure in anything here at these levels, probably not a good thing at this point.
Well, if you look back at the long history of markets, when they get really concentrated, other countries, other sectors, it's been even worse. If you think back to Nokia, right? Older listeners, that was like 70% of their country's index. And so things can always get more concentrated, right? But historically speaking, putting most of your money in the most expensive names is not a great idea. If you think back, the US isn't always the world's largest stock market, right? It's 2/3 of the world's stock market today, 10 times bigger than any other stock market. You go back to the 1980s, Japan was the world's biggest stock market. It hit the highest PE ratio we've ever seen for a country, almost 100. And then went nowhere for multiple decades. Now, oddly enough, it looks great today. Uncle Warren Buffett's been flying over there buying Japanese stocks. But it goes to show that when things get really expensive, it's not just the next quarter or year. These can often last as a regime for an entire decade or more, which for most of us is an investing lifetime or career.
Yeah, so to your point, I mean, you got Warren going over, buying the dip in the haircuts and the sales of some of these companies over in Japan. Another huge market, China, and we're seeing that economy is slowing down more than it has in years. I mean, they're dealing with challenges like an aging population. They got, policy shifts like rising the retirement age. So we can see what this does. I'm curious, though, because you're more macro, Meb, and you look at it from more of a global perspective. I mean, the slowdown is affecting global growth, especially in commodities, emerging markets. How do you think China's struggles should impact global markets, and what should investors be mindful of here?
China's interesting because as a percentage of the emerging market index before their bear market, they were anywhere from a third to half of the emerging markets. Now, everyone's kind of forgotten about emerging markets. No one wants to allocate to emerging markets anymore. But as a percentage of the total, it's still around 10% of the stock universe. And we have a emerging markets ETF, EYLD, and this fund, because it's value oriented, right? It's got a shareholder yield approach, which is dividends plus net stock buybacks with a value tilt. It allocated very little to China for many years. And then nothing cures overvaluation like a market going down 50, 60%, which is what happened with China. And so when things get really cheap, we tend to get interested. And so you've had India, which for forever has been lockstep with China. If you look at their stock markets for the past 20 years, they've really decoupled. So India has been the booming stock market for the past handful of years, and China has been in the doldrums. What causes that to change? We'll see. Maybe it's leadership change. Maybe it's some sort of geopolitical mess. But if you look back at the long history of countries and stock market valuations, like you often see stock markets that'll get down to PE ratio of 5. And that's happened in the US before. And the good news is if you look at the menu of countries right now, probably there's 45-ish investable countries. Most countries are reasonably priced to quite cheap. And the emerging markets tend to have more countries in that really cheap bucket. Now, sometimes for a reason. I think Colombia, we currently have ranked as the cheapest country in the world. But there's nothing that's totally bananas bubble crazy. Like in 1999, there was tons of markets. In 2007, there was a lot of markets that were really expensive. So when we say the US is expensive, we don't think it's a bubble. We don't think it's going to crash and go down 90%, but we just think on average, future returns will be lower for that index compared to other opportunities elsewhere.
So do you think it's wise to invest in China or other emerging markets right now then with these, discounts on evaluations, or is the risk too high at the moment?
Two ways to answer this question. The first is I think the investor's starting point, and no one will do this, is the global market portfolio. So this is just the global index. So that's 2/3 US. Let's call it 60% for math is easier. 30% in foreign developed, so countries like Japan, Canada, UK, and then 10% in emerging markets. That's the starting point. If you want to move away from there, you can. If you say, hey, like me, I'm a romping, stomping bull on emerging markets. But that doesn't just mean China. It means all the markets because they've been largely forgotten. We think it's a great time. You can get single-digit PE ratio, mid-single-digit dividend yields, buyback yields on top of that. You get up to about a 10% combined shareholder yield. There's a lot of opportunity. And interesting, by the way, our U.S. shareholder yield fund has very little exposure to tech. Tech in the U.S. on average is expensive, and they issue a ton of shares, usually to management through stock-based compensation. So we don't have a lot of tech exposure. Tech is the number one sector in our emerging market fund. A lot of that is because emerging markets have done so poorly. There's a lot more opportunities, but it's interesting to note that a value investor is finding a lot of value in emerging markets.
Yeah, no, that is. Okay, well then, when you look at the job reports in the U.S., they show hiring is slowing down, fewer jobs added than expected in recent months. And obviously there's still concern about this whole R word, the recession. Do you view defensive sectors still, some assets that are looking positive here, healthcare, utilities, are they still attractive?
If you go back and model the shareholder yield or type of strategy, which is on average a quality strategy, it traditionally doesn't keep up during the romping, stomping bull markets with the S&P. Really nothing does. But in the sideways and down markets is usually where it shines. Look at Warren Buffett from 2000, 2003. Buffett and then something like a small cap value strategy outperformed the market by 150 percentage points. So in very short periods, you can have this sort of value quality tilt. When things hit the fan, you may not even have a bear market in other markets. Now, something like a 2008, 2009 is going to be different because everything gets toilet flush. But on average, the value and quality type of ideas. Now, if you look at things that are crazy, like trade at like 10 times sales, 10 times revenue, on average, that's a horrible investing strategy. But every once in a while, maybe every 10 or 20 years, it does a little face ripper up, and these type of stocks do great and then continue going back down and outperforming the market. So right now, you have these Venn diagram overlaps, small cap, mid cap, value, quality, all really looks outstanding versus this expensive bucket. But the exact timing is who knows, but we think the better part of the next few years, next decade could be exciting.
Yeah, it's been a heck of a year so far, not to mention we get this election next month. Okay, Meb, gold prices, as you just mentioned, have recently surged past that 25.50 US mark on the spot side. New record highs. I'm not seeing a ton of media coverage. I got quite a bit of different TVs in the studio. I'm not seeing anyone talk about it. Given your deep knowledge of global markets and investment trends, do you think gold will continue to climb? Or are we nearing a point here where investors should be cautious?
So half of my brain is value and the other half is trend following. And trend following is long, both have over 100-year history back to the time of Ben Graham and Charles Dow writing about Dow theory and trend following. And trend following is a unique exposure because if you look at the US market, for example, the US market is currently expensive, but it's going up, which is the second best quadrant of the four the best, of course, is cheap and going up, and the worst is expensive and going down. But it goes to show that even if something's expensive could do well. Gold, by the way, is in an uptrend. It's an all-time high. We wrote a paper called "Is Investing at All-Time Highs a Good Idea? No, it's a great idea." And a lot of people, it's uncomfortable to invest in a market when it's an all-time highs. But there's only two states for markets. They can either be in an all-time high or in a drawdown. There's nothing in between. And so gold, hitting all-time highs is a great sign. And trend following traditionally does a great exposure. We have a very large exposure relative, I think, to most, other than my Aussie and Canadian friends, to gold and gold miners currently. I just texted my buddy, though. I agree with you. I said, hey, he's at the Beaver Creek Gold Conference right now. And I said, what's the vibe? What's the environment? Because at least in my world, I don't feel like anyone is really talking about it. The sentiment is not like what you traditionally see when markets are at all-time highs. So usually that means there's probably some more juice, but who knows? But as for right now, we're definitely very positive on gold. And traditionally, gold does great in this sort of negative real rates world, a negative yield curve world, and so we're very positive right now.
Yeah, I think it was Peter Schiff tweeting about, he loves when the media is not talking about it because it just gives them an opportunity to pick up more. I mean, some analysts suggest that this high price already, has a lot of the risk kind of baked into it. So are you advising, to hold gold? Are you considering buying more, or what are you thinking here?
Not to mention either of those, If you look at the long term on the trend following, it's the time you want to be investing. Now, the gold miners is interesting and it's different. So we did the same friend. I said, why are the gold miners underperform gold so much? And he's like, well, a lot of them, more than any other sector, they can tend to be poor capital allocators. They love to spend money. The old Mark Twain quote, right? They just want to throw money down this hole. And he said, if you want to, tilt towards the ones that are thoughtful about capital allocation. And so we ran a test across not just gold, but every sector and industry in the United States, testing the shareholder yield methodology, which is a quality type of methodology. So if you're distributing a lot of dividends as well as doing net stock buybacks, you kind of have to be capital efficient, right? You have to have the cash flow in the first place to distribute it, but also you're being shareholder friendly. That's the G in ESG for governance. But it also is, what are you avoiding? You're avoiding the stocks and the companies that are just spending like crazy, not paying out dividends, and issuing shares too. And so it turns out this type of approach works great in gold mining and mining in general, but it also works great in every sector and industry. It's thoughtful to have the CEOs aligned with the shareholders makes sense.
Yeah, no, it's interesting. I mean, we have a team on the ground at Beaver Creek as we speak, and I think we've had some great content this week. It sounds like it's going to be the year of M&A. I mean, at these prices, as you said, a lot of these juniors have blown out their share structure, had to raise capital in terrible environments, and so their evaluations are low, and maybe it just means that the big guys are coming shopping. I mean, potentially, that's
Makes
the hope.
Makes sense. I think so.
Okay.
But yeah, but the funny thing is most investors have almost no exposure to commodities in general, but certainly not gold either. So we think if you look back in the history of asset allocation portfolios, particularly in things like the 1970s, not much really saved your hide other than having a decent allocation to things like gold.
Mm-hmm. Yeah, no, well said. Okay, well, I mean, some investors are chasing growth in other areas, as we talked about, tech, AI. They don't want to miss out on those social media gains, is what I like to call them, right? Others are shifting towards T-bills, like you said, bonds, gold, cash. You have a pretty interesting macro take here. I mean, you study it a lot. You said your brain kind of goes in that 50-50. Where are you putting your money?
Yeah, so we start with the global market portfolio, which most people already don't do. Most people around the world put almost all their money in their own stock market, which is crazy. And if you ask anyone in the other 44 countries outside the US if that's been a good idea, they would say, no, that's insane. I wish I had followed the global market portfolio. Someone in Brazil or Russia or UK, on, Greece. And so diversifying across countries makes sense. Second is we think that diversifying into real assets, that's the second big mistake most people don't make. And so that's not just things like gold, but also things like REITs and things like TIPS. Treasury inflation protected securities. They give you protection in inflation and unexpected inflation, and then global bonds as well, and not just U.S. bonds. That buy and hold portfolio, we call it the global market portfolio, is hard to beat. Now, we say, and we're an outlier here, so this is very non-consensus, we also say most investors need a big allocation to trend following, and that could be managed futures, it could be various types of trend following strategies. And putting those two together in a yin-yang way, we call the concept Trinity, for us is a very thoughtful way to go about it, because usually during the big bear markets, the 2008s, 2009s, the 2020 COVID downdraft, buy and hold's tough because you don't do anything, right? You just got to hope things get better. Trend following usually does great during those periods, but often will do poorly when the S&P is romping and stomping or buy and hold is going crazy. So the diversification of those two together, to me, is not just from a portfolio statistical standpoint, but a psychological one as well. It diversifies your mental happiness, your ability to withstand, which is the whole point of everything we do, is right. Can you get to the finish line with your goals and make this path a little bit easier to bear? And for many, the volatility is the hard part. So putting those two together, we think, is really thoughtful with a value bent, right? So moving away from these market cap and indexes into value will put people in great shape today. We think it's an awesome time to be an investor.
Yeah, absolutely. Buy the dip. All right. Meb Faber joining us today from California, Chief Investment Officer of Cambria Investment Management. Thanks for doing this, man. Hopefully we can have you on in the next couple of months and see where we land here and do another one of these.
Thanks for having me. Have a great weekend.
Thanks, Meb. Appreciate it. I'm Jeremy Szafron for all of us here at Kitco News. Thank you for tuning in. We got great coverage coming up. As I mentioned, we got a team on the ground over at Beaver Creek. We'll have, of course, Fed coverage next week. Stay tuned. We'll see you next time.